Welcome to Market Catalyst. I'm Jared Blikre. We are 30 minutes into the U.S. trading day. Let's get to the three market catalysts we are watching this hour, the last morning hour that we have programming for 2025. First up, we break down the risk factors facing investors heading into the new year. Plus, we're going to bring you the economic outlook for 2026 with a new survey from small business owners. And in this week's ETF report, we're going to look at the three investment themes for exchange-traded funds you're going to want to watch in the coming months. So let's take a look at the major averages, and this is another down day. We've seen kind of a streak of these. Let's pull up the intraday price action in the Dow. Well, there we have just 30 minutes worth, but let's pull up the 5-day. That's because we are 5 days into the Santa Claus rally, which is actually an indicator. I'll explain that in a second, but as you can see, the Dow underwater here. The one that counts is the S&P 500. That's down 1/3%. And we got 2 more days in the Santa Claus rally. That's Friday and Monday, the first 2 trading days of the new year. And if they are positive, and this is why it's an indicator, that portends a bullish year. And if it's negative, well, odds are just slightly that we might have a negative year. There are 3 total indicators that we want to take into account for the month of January. So it's not the final word, but things are looking a little bit bearish for 2026 already. Can you believe that? 10-year T-note yield is up 1 basis point to 4.14%, and 30-year is flat at 4.81%. You can see it's just been chopping around these last 5 days. And US dollar index, that is net up over the last 5 days, but just barely, about 0.4%. Nothing to write home about. And let's take a look at the sector action. Everything now in the red, all 11 large cap sectors. To the downside, led by real estate. Then you got tech, materials, communication services. The least dirty shirt in the laundry basket here in the US is utilities, followed by healthcare. Both of those down just slightly. Let's take a peek inside the NASDAQ 100. A lot of red here. Nvidia's a standout, so is Tesla, but those gains under 1%. But you're not seeing a whole lot of dark green or dark red here. These are just some choppy end-of-year moves it's looking like. And here's the Dow. Another kind of bearish picture here. JP Morgan slightly in the green, so is Visa, but for the most part, most of these names down. Not seeing anything down by more than 1%, so that's a good news. Nike, by the way, here's a bright spot, up 1.98%. See if they can turn it around in the new year. And we will close with let's actually close with crypto, because that has been on investors' minds all year long. We can see Bitcoin down about 2/3% over the last 24 hours. Ethereum also in the red, and then Ripple down about 0.4%. And the global trade war is on the front burner for most of 2025. It rattled markets, world economies, and investor portfolios. So let's bring in Henrietta Trey's Veda Partners Managing Partner, Director of Economic Policy, for a look at what the trade and tariff picture might look like in 2026. So Henrietta, thank you for coming here today and chatting with us. Let's start with tariffs, because you have a bold prediction for 2026 that the Supreme Court is going to do something with tariffs, and I'll let you take it from there.
Yeah, that's exactly right. We're waiting very eagerly for this $3 trillion binary event. Is the Supreme Court going to let the president keep all these tariffs in place? Or is he going to say, actually, you don't have this authority? And 2026 is going to be relitigating a whole host of things that we went through as investors, the bond markets in particular, around whether or not he's going to fire Jay Powell or try to do that. I would really watch Lisa Cook there. And then also on these tariffs, if the tariffs have to come off, if the Supreme Court says you can't put these on under the authority that you used, then the president's going to have to go through Liberation Day all over again. I'm calling it Liberation Day 2.0, because he'd have to once again put markets, small businesses, large businesses, the bond markets, through the exact same charade that we did in April all over again. Whether we migrate from IEEPA to 232 tariffs or 301 tariffs, or 15% tariffs for 150 days. The confusion and the opportunity for mass chaos is just as real as it was in the second quarter of 2025, when we got far more tariffs than we expected. So the market is going to have a lot to respond to in 2026, hopefully soon.
Yes, and I want to linger there for a second, because I want to take the flip side of that. If the IEEPA, those tariffs are overturned, well, that gives a lot more money in the pockets of either Americans or corporations. We saw corporations react by really limiting the price increases that they had to enact on consumers, but their margins shrunk. And so I would tend to assume, just sitting here, we're either going to see expanding margins or a lot more money in the pockets of Americans if this is overturned. How do you see this gaming out?
Yeah, exactly. It could be a huge win for the Republican Party, who has to run on the president's trade agenda, which the American public overwhelmingly disapprove of. There's a 67% disapproval rating of the president's tariffs. People know that they're the reason that they're paying more at the grocery store or at convenience stores or even at Walmart, Target, anywhere, Nike. Everybody that is selling you something is paying part of the tariffs. And so for the average American household, it equates to an $1,800 a year hit that we are taking on average. And it's regressive. So there's a huge part of the population in the middle and lower income brackets who are paying a disproportionate share of their income in these tariffs. And they don't like it, as I suggested earlier. So one of the boons that the Republican Party could face going into a midterm election cycle is to have the Supreme Court say, you know what, you got to take these tariffs off. I think a lot of members on the House side in particular, all of whom are up for re-election again, would be really happy to hear that, as voters would get that money back in their pockets. The issue for the White House is that's obviously contrary to what the president's agenda is. So big problems for the White House.
Yeah, but a lot of food for thought there, so I appreciate that analysis. Let's talk about another government shutdown. We just had the longest one on record, and now it looks like we're going to be walking into the new year with the possibility of another one. Then can you game that one out too?
Yeah, happy to. I don't think that we're going to get another shutdown. I generally tend to think that we won't shut it down. The Democrats proved their point in the 45-day shutdown earlier this year, and I don't think the language we're getting from Leader Schumer is indicative of another shutdown. One of the things that I would really point out is it's not necessarily about a policy win. You know, the ACA subsidies are going to expire, so you're going to be paying more for your health care next year. $200 if you're below 40. Up to $920 if you're over the age of 60. That's going to happen starting, well, I guess tonight. And as we get into the end of this year, that's what the conversation is going to be. But because there's no consensus on moving forward, and Democrats have made their point, and Republicans are guaranteeing that there will be votes, and we're going to have this conversation, we'll talk about it. But I don't think we're going to shut it down. So my odds are 25%. I think fade that. I don't think we're going to shut down going into February.
Oh, good news there. And before we go, I want to talk about the Fed, because we know that the Fed composition changes every year in terms of the voting members of the FOMC, but we get an additional change this May when we're going to get a new Fed chair. We'll probably find that out exactly who it is in the coming weeks. But what should we expect there?
Yeah, so obviously all eyes are on the Kevin still. The president said he hasn't changed his mind, so that's good news for Kevin Hassett. I think the market is sending a pretty clear message that they do not want Kevin Hassett to join the Fed. But that conversation is going to stay under pressure because also, as the president said, he is thinking about ways to continue trying to fire Jay Powell early before May. And certainly to get him off the board before 2028. And I think the Lisa Cook case, as we hear about that early next month, will be really indicative of how aggressive the president feels like he needs to be on the Fed. I think Jay Powell is a useful foil for the president. He can blame all the concerns about the economy on the Federal Reserve, and too slow Powell and all those nicknames is really helpful to the White House as they're dealing with inflation and saying, prices would be lower if we had a different Fed chair, or, everybody needs to help the housing market. We need a new Fed chair. It's a constructive use of his time to blame it on Jay Powell. I don't think that we'll see him completely relitigate trying to fire Powell. The market did not respond well to that last year or this year, but they're not going to respond to it well next year either. But it will definitely be a continued theme, and hopefully we'll get a nominee in the next couple of weeks.
Hopefully. Henrietta, it has been enlightening. Thank you so much for joining us here.
Thanks for having me. Happy New Year.
Happy New Year. All your markets action is ahead. Stay tuned. You are watching Market Catalyst. In the latest Comerica Small Business Pulse Index, a majority of business owners polled say that they're wary of the impact of tariffs in 2026, but they're still optimistic as we turn the calendar. So let's go through now the details with Bill Adams, Comerica Bank Chief Economist. Bill, thank you for joining us here. Talk to me about tariffs. We know that they impacted everybody from businesses to consumers in 2026. To what extent did they hit small businesses, and then what's the outlook for 2026?
Good morning, Jared. We saw respondents to our survey in the fourth quarter of 2025 pointing to tariffs as one of their biggest problems. Businesses also highlighting pressures from inflation in the Comerica Small Business Pulse survey as one of their biggest challenges. And so this really is reflecting what we thought we knew about how tariffs were affecting small businesses. Smaller businesses have narrower profit margins, they have less pricing power, and so tariffs are going to be more of a pressure on their operating models and on their profitability than on larger businesses that have more flexibility in how they respond to tariffs.
We were just talking to a previous guest, Henrietta Trey's of Veda Partners. I don't know if you were listening to the discussion, but her thesis is that the Supreme Court could strike down those Trump tariffs from 2025, and that would just give a lot of leeway for consumers, businesses. What do you think about that?
Our view is that if the tariffs are invalidated, I would expect that the administration would probably look for other ways to implement tariffs to maintain a high average tariff rate. As a macroeconomist, the way I view the impact of tariffs is I look at the average tariff rate across all goods and services imported into the United States. It's a sales tax. And so what is the average increase in the sales tax versus prior to the tariffs? And so it's likely that the government has other tools to implement sector or product specific tariffs that would keep the average tariff rate considerably above what it was at the start of 2025. So probably if we saw those tariffs invalidated, we could see some businesses get tariff refunds. That would be a boost to their cash balances going into 2026. But going through the rest of next year, I would expect that the average tariff rate will still remain high. And so imported goods will continue to be subject to tariffs, most likely.
Well, I appreciate that perspective. Moving on here, your survey shows, or Comerica's survey shows, that tech and construction are leading optimism, while sole proprietors and retail, they're more cautious. And we talk about the K-shaped consumer quite a bit here. That is, in the letter K, you got one leg going up, the other going down. Is it possible that we have a K-shaped small business community as well? What does that look like?
My interpretation of the Comerica Small Business Survey's breakdown by industry is that you're seeing a lot of the impact of the tech boom on the one hand, which is really driving demand for AI services and for ancillary services for businesses to bring those new technologies into their operating models, versus the impact of the lagged effects of the Fed's high interest rates on the housing sector and on the construction sector. If you look at the third quarter GDP report, which came out earlier this week, very volatile, right? The annualized changes have been swinging all over from quarter to quarter. But if you look at that year over year comparison, the parts of the economy, the parts of the economy that haven't been growing in 2025 are investment in structures. So non-residential structures, residential structure spending, those are down year over year in real terms. It's the only part of fixed investment that has not been growing in the U.S. economy. So I think that explains a lot of the headwinds that we see in the small business survey, in addition to the pressures on low and moderate income households, which are affecting the retail sector.
And we got to talk the labor market, because as you've been writing recently, it hit an air pocket in the last quarter of the year. What does that mean going into 2026, and especially with respect to the Fed and any AI effects from this as well?
I think the impact of AI on the job market so far is mostly that businesses have been prioritizing spending on AI and AI investment, and so that has meant that the company's budget is set by its revenues, and the share going to technology investment has increased, and that leaves less money to hire more workers or to invest in other initiatives. And so AI has kind of been sucking the air out of the room, so to speak, for corporate spending and for small business spending as well. And so that's one of the reasons why we've seen modest job growth or weak job growth in the last couple of months, despite seeing solid real GDP growth. In 2026, I think we're likely to see a broadening of economic growth fueled by the Fed's 0.75% in rate cuts in late 2025. And that's likely to fuel a recovery of activity in the housing sector, as well as related industries like retailing of furniture, retailing of household appliances, et cetera. Probably also see a boost to auto sales in the new year from the SALT tax deduction increase that passed on July 4th. So all of that, I think, will lead to more business activity in industries that tend to throw off more labor demand than the industries that performed best in 2025.
Interesting. We got time for one more, so I'll give you the floor. Anything in the survey or just in general that you'd like to tell the viewers as we start the new year?
I'd highlight that in the Comerica Small Business Pulse Survey, the headline and the point that we want to leave small business with is really optimism going into the new year. A strong majority of businesses are upbeat about their outlook into 2026. So despite all of the challenges from tariffs and from persistent inflation, we continue to see growth ahead for small businesses. And I think that points to a year of solid economic growth ahead for the U.S. economy as well.
Always nice to end on a little bit of optimism. Thank you for that, Bill.
Thanks for having me.
And coming up, how one of the biggest names in software sees artificial intelligence changing the space. Welcome back to Yahoo Finance. Let's get a check on the markets. And we're looking at another down day here to end the year 2025. Here's the Dow down about 0.25%. So is the NASDAQ. So is the S&P 500. I thought we'd take a look at the year-to-date scores on the door. Here's the S&P 500 up 17%. And let's not forget, we had two back-to-back years of 20+% returns. They said it couldn't be done this year, and it looks like we're going to fall a little bit short. But that is not bad considering what happened down here, that post-Liberation Day sell-off. Here's the Dow Industrials up about 13% for the year, and the NASDAQ up 20%. So we're getting 20% plus gains in the NASDAQ composite for 2025. Also want to show you the Russell 2000, which has been frustrating traders for years, nevertheless posting gains of about 11 or 12% here. Checking in on the sectors once again, everything in the red, not by a large amount. Utilities leading, the least worst off, and real estate down about 0.7%. Let's take a look at the year to date, and we can see tech, another year of strong gains for tech, up 25%. Next up is communication services. That's where you're going to see Meta and Alphabet. Then we got industrials, Boeing, a big, and a lot of the aerospace defense stories that we've seen contributing to that. All three of those outperforming the S&P 500. To the downside, only real estate and staples looking like they are going to close the year in the red, and they could still climb into the green there. And let's check out the NASDAQ 100 scores. NVIDIA up 40%, Broadcom up 50%, Tesla come from behind story. That just climbed into green territory about a month ago. That's up 12.5%. And then some Alphabet up 65%, but some lackluster results from Meta, Amazon, and Apple there. But if I sort by performance, you're going to see a lot more green than red. The best off, that would be Micron, up 240% in the upper left, followed by WBD, Warner Brothers. Then we got Lam Research, Palantir. We know these names, a lot of chip names in there. Intel come from behind story. That was up 87%. To the downside, Trade Desk down 67%, a cool 2/3 of that value shaved off, followed by MicroStrategy after a huge year last year. That's down almost 50%. Lululemon also almost cut in half. List goes on. I'm going to close here with the Dow and show you what these members have been up to. We just covered some of the mega caps, so let's focus on these. And I'm going to sort by performance. In the upper left, industrials, third best sector of the year. Guess what? Caterpillar has been fueling a lot of those gains, up nearly 60%. Don't count out financials. Goldman Sachs up over 50%. Then we got J&J, a staple. Go figure. That was up 43%. And then we get some familiar names like NVIDIA, even IBM up 36%, pressing of record highs much of the year. United Health was a big disappointment. That was a 35% drag on the Dow, followed by Salesforce and Nike, each of those down about 20 to 17%. A few others in the red there, but for the balance of these names that we haven't talked about, mostly green. So let's move on here because we got Palantir, Oracle, and CrowdStrike, just a few of the software stocks that are set to end the year with significant gains. But largely, the space has yet to see a boom as the AI revolution gets underway. At Yahoo Finance Invest, enterprise software pioneer Robert F. Smith told Julie Hyman that he's never been more excited about the space.
What we are finding is a massive amount of productivity that comes, not surprisingly, from all aspects of what this technology distributes off the infrastructure that we are managing. If you think about productivity in product development and customer service, customer support, go-to-market, all those dynamics, we're seeing massive productivity. We are built for growth as a firm. We're going to continue to grow. What's interesting is as you grow, you can actually grow without adding as many people, which is the way you actually have to think about this. Now, in certain instances, there are going to be certain categories of jobs that become very much affected by artificial intelligence and Gen AI. Other categories become very much more enabled by that. And so it's a balance of expression and expansion as you get these systems to actually operate at scale with capacity. And part of what we've been leaning forward in doing with all of our portfolio companies is we've built out now an agentic factory. We have some fantastic partners. We're now able to take the architecture of these workflow systems called enterprise software, the unique data sets, which less than 1% of the data in enterprises actually exist in these foundational models, and actually create agentic solutions that create highly efficient dynamics in operating through these existing workflows. That's a unique aspect that enterprise software companies can actually embrace. The value of incumbency is really going to matter in certain of these industries. So that productivity will actually absolutely make its way through the overall economy and, of course, private equity firms ultimately. Right. We have unique workflows in private equity firms that we can actually leverage these solutions.
Okay, so what did that story get wrong then? I mean, because all of that would indicate that you're pushing towards a leaner workforce potentially, or as you say, maybe deployed in different ways.
Yeah.
So what did it get wrong?
We are not reducing our staff by 30% or whatever the number was. I don't know where they got that from.
Are you planning to slow hiring as a result of all of this?
In certain areas, yeah, for sure. But when I look at the work that we do in our private equity business, our credit business, our value creation business, massive amount of opportunity. And here's why. If you think about the waves of how technology have played out in over decades, the first wave, of course, is typically I call it the hardware providers capture the vast majority of the economic benefit. Second wave typically are what I call the service providers, infrastructure providers, in this case, hyperscalers capture that benefit. And you're seeing that play out. It is the enterprise software vendors ultimately that, if you have, I call it sovereignty and dominion over workflows and data sets, that have the ability to take this agentic solution sets and capture massive amounts of economic rent opportunities. It expands their TAM dramatically. One of our first companies that went through our AI factory, our agentic factory, it now has expanded a market now 10x what they had before. Now, the way I like to say it, Gen AI will enable enterprise software to eat services. Okay, it will create a massive amount of efficiency in the work that it does and workflows, and we are now installing these systems real time across literally hundreds of customers, and it's non-trivial work. But as you do the installations, we're actually starting to see the benefits of it. Of course, we're taking those same sort of systems, and we have been within Vista and saying, okay, what are the areas within a private equity firm that we can leverage so that our people can become more productive, they can expand their area of their TAM of opportunity. And the good news is the enterprise software market right now has a disproportionate valuation relative to, call it, the AI groups. That as you make these agentic and AI enabled, I think these businesses are going to create massive upside and opportunity for our investors. That's what we're focused on.
So there's so many threads to pull on in there. I guess I'll start with the valuation question first. Do you think that publicly traded AI is in a bubble?
So it's an interesting question in that, you have to build out infrastructure. And again, being a student of history around as an investor, you have to be. It took massive amounts of capital to build out the infrastructure that we benefit from now. You remember the global crossings of the world, building out cable and fiber. And some of those companies went bust. It was in a bubble. Some of those companies ended up being the winners because they built at the right time, right capacity, and the needs and demands of what the market.
Although in some cases they took
demand of.
Decades to come back
in some cases.
Stock prices.
Absolutely. So those are the dynamics. Everyone looks to be, we're putting trillions of dollars into an infrastructure that is a question of, do you have enough power to support it? And you argue, is there a bubble because you can't support it with the power? There's an argument around that. Are there enough component parts? Is there enough distribution? Are those component parts that we are looking at today going to actually have give the power demands that are required? We're hearing, of course, there are other solution sets that have lower power by a tenth of what we're seeing. So do you need the same sort of power? So all of those are market dynamics that have to reach certain points of equilibrium over time. Where we focus, again, all of that provides infrastructure for enterprise software. At the end of the day, what we're going to be doing is utilizing inference. You can put it in the form of tokens, utilizing inference to create massive economic rent and productivity for our customers. That will all inure to the benefit of those enterprise software vendors who become agentic. So there's going to be ebbs and flows over who is actually capturing what value at what period of time. Certain folks will have monopolistic positions for short periods of time, and then others will come up with, like an all silicon, different solution sets that will be lower cost, suit to purpose, different infrastructure. Do you have to have it all centralized? Can you do it at the edge? In terms of the inference capabilities, do you need 1 gigawatt power supply, or do you need 50 megawatt to do certain inference for certain use case applications? And is that more suitable for that use case application? So we're going to go through those waves, and some parts of this market are in bubbles, and other parts are very much in a great investable space.
Do you think that power is going to be the main constraint on the build out of AI in the shorter term?
In the short term in the U.S., yes. I think in other parts of the global economy, they have an excess of power, relatively speaking. The question is, can they utilize that power to actually power Gen AI or agentic or data systems or GPU data centers in a way that is accessible and usable for those who need it? Mm-hmm. So again, there's not only the power dynamic, there's accessibility, what are the requirements of latency, and what are the size of the models for the use case and application. Not every model needs a massive LLM. Some will be able to use some small language model in an environment to deliver a high capacity solution for that particular industry. So again, it's early, it's a lot, but it has massive implication and massive productivity. So we're excited to be a part of what I call the edge of this thing, which ultimately is the enterprise software will capture benefits. We built these businesses now. We're converting. I think we have 18 of our companies now that already have agentic solutions in the market that are getting installed or have been installed and seeing real results. And I am just really excited. I've never been more excited about investing in enterprise software than I am today.
And coming up, we're going to bring you the outlook for commodities as oil heads for its worst year since the pandemic. Oil is headed for its biggest annual drop since 2020. The commodity has been pressured by surplus concerns, which are expected to continue into New Year. Let's join us now with Pavel Molchanov, Raymond James Managing Director of Equity Research. And thank you for joining us here today. Let's tackle the outlook for oil first. We saw a huge run up in gold and precious metals this year, but we didn't extend that to certain sectors, including the energy one. So what's the outlook for 2026?
Yeah, so look, oil this year has been under pressure for two reasons. One is sluggish global demand. In China, 60% of auto sales are now electric, and that number is only going to increase. Meanwhile, OPEC has been unwinding its production cuts from the COVID era. And at the same time, we have so many new oil fields starting production in places like Brazil, Guyana, and Norway. You put all that together, we have an oversupplied market for the fifth consecutive year. 2026, we think it's going to be a sixth consecutive year of an oversupplied market. Now, does oil have a lot of downside from here? Probably not. Below $55 a barrel for WTI. That's kind of the threshold of pain, as we call it, for the oil industry. That's where, the rig count begins to, fall off a cliff and company capital spending declines. So not a lot of downside left, but no real reason for prices to go up either. You mentioned a minute ago, peace talks with Russia and Ukraine. Mm-hmm. if those were to reach an actual peace deal, which seems like a pretty good bet for 2026, that if anything would pressure oil prices even further.
Yeah, and I would like to call the Wi-Fi Interactive up right now. We have a heat map of our energy companies. Most of these are large cap for the year to date. We got some big numbers up there, some small losses. Occidental down 16%, but the majors like Exxon, Chevron, both in either the single digits or low double digits. What's the outlook for energy companies heading into 2026, given what you just said, that we're headed for probably another year of lower oil prices?
So the stocks, just like the stock market, is not the same as the economy. The energy sector of the stock market is not the same as the price of oil. It is possible for stocks to do relatively well, even when the commodity itself is under pressure, and here is why. Pre-COVID, the oil industry was all about drill, baby, drill. It was all about growing production and investing as much capital as companies could afford. Since the COVID era, we've seen much more of a capital disciplined approach within the oil industry. Companies are not trying to grow for the most part or very slowly. Instead, they are returning capital to shareholders in the form of juicy dividends and lots of share buybacks. And the big oils are the most active in doing so. So if oil prices are, let's call it flat to down in 2026, those dividends and those buybacks are still going to continue, which keeps the stocks, in favor for some investors, even though the underlying commodity has no real upside.
We got to talk AI here. I believe you've argued that big energy story is not about oil necessarily. It's AI colliding with the electric grid. And we do have U.S. electricity demand projected to grow 2 to 3% per year into 2030. So what's the 2026 setup here for AI, the electric grid, all that good stuff?
Okay, so first, let's just say this is a crowded trade. If we had this conversation 2 years ago, anything electricity related was perceived as a mature, kind of rather dull, slow-growing industry. Now it's quite the opposite. This has been a derivative on the data center boom. And so utility stocks, by and large, are at record highs. Independent power producers, same thing. So the good news is, as you noted, power demand is growing. In fact, it's likely to grow as much in the next 5 years as the previous 25 years combined. At the same time, we have a lot of regulatory scrutiny of rising electric bills. If you look at the opinion polls, voters are frustrated with the fact that power prices are rising faster than inflation. This is going to lead to more regulatory and political pushback. In some cases, you could see regulators begin to kind of crack down on some of the utility demands for rate hikes. It's obviously going to vary state by state, kind of region by region, but there is a risk factor to keep in mind. So the side effect of this booming in power demand is the fact that all of us are going to be paying more for our electricity with each passing year.
All right. We will have to end it there. Pavel, learned a lot here. Thank you for your insights.
Thank you.
Coming up, a look at another record year for ETFs. ETFs had a record year in 2025 with over $1.4 trillion in inflows. Some of the best performing areas included precious metals and miners, driven by higher gold, silver, and copper prices. But looking ahead to the new year, where can investors seek new opportunities in the ETF space? I'm joined now by Aniket Ulal, CFRA, Head of ETF Research, for this week's ETF report, brought to you by Invesco QQQ. And thank you for joining me here today. I know you got 3 ETF trades to watch in 2026. 2026. So let's tick through them. I'm going to start with pharmaceuticals, healthcare, and I'm going to show us the Wi-Fi interactive here. This is just the year to date of a number of companies in the basket. Some of these are going to appear in a lot of your favorite healthcare ETFs. What do you like about healthcare coming into 2026?
Well, Jared, I think your chart captures it well. As you can see, a lot of the top holdings in pharmaceutical ETFs like PJP have done really well this year. We've seen the sentiment around healthcare change in the last quarter of this year, but particularly around pharmaceuticals and biotech. As you know, within healthcare, you have also the managed care segment. We think that segment will continue to be under pressure because we've seen big cuts to healthcare and Medicaid and so on. So companies like United Healthcare and so on have been under pressure since the One Big Beautiful Bill. But on the pharmaceutical side, we've seen a lot of positive sentiment, particularly around the most favored nation pricing deals that many pharma companies have done with President Trump's administration. That really removed some of the uncertainty around tariffs. And so that's really kind of helped the sector, and we think one of the positive sectors going into 2026 next year.
And number 2 on your list is buffer ETFs, and these try to give you a little bit of hedge to the downside, but they also cap the upside. What do you like about this particular class of ETFs?
What's interesting is that even though we've seen such a strong equity market this year, and we've seen so many inflows into AI and robotic themed ETFs, we've also seen a lot of investor appetite for downside protection. This is particularly true from those investors who are getting close to retirement or are in retirement. Buffer ETFs allow investors to stay invested in equities while, like you said, protecting some of the downside. And so investors have been able to trade off some of that upside in exchange for downside protection. We think next year, given that it's a midterm election year, there could be some more volatility in the market. This category could grow. Buffer ETFs have taken in over $10 billion every year in the last 3 years. And we think next year should be another good year too for buffer ETFs.
And then we got to talk about international, because they really stole the scene earlier this year when we had that huge post-Liberation Day sell-off on the US. A lot of country ETFs have far outpaced the S&P 500, whether it's Korea, Poland, or Peru. So what do you like about some of these international markets and maybe even emerging markets heading into the new year?
This has been one of those years where investors have been rewarded for holding stocks outside the US. Otherwise, it's been a pretty dismal period for international investing. But this year has been very good. Korea has been actually an exceptional year, particularly in US dollar terms. Korean ETFs are up about 90%, in local terms up about 70%. These ETFs, of course, benefit from a weaker dollar. That trade is probably more related to semiconductors. We've seen a couple of big Korean semiconductor companies do very well, Samsung and so on do very well this year. We've also seen European markets do well, Spain, Italy, Greece, southern European markets. That's driven more by financials and utilities. Some of these countries tend to be very heavy in exposure to financials and utilities, two sectors that have done very well in Europe. So we think the outlook there is positive as well. So it's been a good year for those holding international ETFs. And we think 2026 could also be another good year for ex-US equities.
And we're going to get you out on this. Let's talk about leverage ETFs, because about 1 in 4 of each new ETF listing this year was a leverage product. And I'm just wondering, do you think this is just a fad? Is this here to stay? Because we saw the first wave of leverage ETFs come in 2007, 8, 9, 10, and then they kind of dropped off for a while. I think the flash crash and some other market hiccups had something to do with that. But bottom line, where do you see the leverage ETF market in 2026?
In terms of product expansion, I think we'll continue to see more launches. Unfortunately, not all investors have benefited from these products. We've seen many cases, particularly leveraged crypto ETFs, where money's gone in, but investor returns haven't been great. So investor outcomes in the leverage space haven't necessarily kept pace with the launches. I think next year we will see maybe liquidity pooling around a couple of products, but I think beyond those, the sector may struggle a little bit, and we may see some closures outside of a few successful products.
Yeah, and we thank you for your insights here, and we will see you in the new year. Thank you for that, Aniket.
Thank you.
And this, by the way, was brought to you by Invesco QQQ. And that is going to do it for Market Catalyst. We have more market coverage up after the break.